Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined the show for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. One very privileged thing that we get to do is speak to some of the best investors, not just in Australia, but around the world, from some of the largest financial institutions from around the world. And this is a classic example of that. Speaking to someone from $1 trillion asset manager all the way from New York.
That's right, Ren. It is our pleasure today to be able to speak to Tony Crescenzi. He is an executive vice president, market strategist, and portfolio manager at PIMCO, all the way from their New York office.
Now, PIMCO is the world's largest fixed income manager or fixed interest manager, depending on where you are in the world, is how you say it. It's the same thing, though. They're mainly investing in bonds.
Yes.
And PIMCO are investing in trillions of dollars worth of bonds for some of the world's largest institutions, endowments, and funds. So Tony has his finger on the pulse on what the bond market is telling us. And that's where we start the conversation today. Really, the last month and a bit since Trump's Liberation Day tariffs, the markets have been volatile. The bond market has been volatile as well, and we really picked Tony's brains on what we can learn from the way the markets have moved, but also where he and PIMCO think markets might go from here. But then in the second part of the interview, we talk about investing in the bond market because for a long time, really for the length of time we've been doing Equity Mates, fixed income has been kind of the unloved stepsister of the stock market. The stock market has been exciting with these, tech companies, and the bond market has seen yields at historic lows, and people haven't really been investing in that space. We've seen plenty of articles about, the 60-40 portfolio, 60% stocks, 40% bonds, being debt. But God, has that changed in the past few years?
It has. We get some insight from Tony on how we should think about investing. And the good news as well is that PIMCO now have 4 active ETFs available here in the Australian market. Just to quickly run through them, there's the PIMCO Global Bond Active ETF, the ticker is PGBF. The PIMCO Australian Bond Active ETF, PAUS. The Diversified Fixed Interest Active ETF, PDFI, and the Global Credit Active ETF, PCRD. In this interview, Tony specifically talks about the Diversified Fixed Interest Active ETF. We should say, Ren, a massive thank you as well to PIMCO for sponsoring this episode and for making sure that we can keep all of our content free and accessible and get access to incredible minds in the investment industry like Tony himself.
Yeah, so without any further ado, let's get to our conversation with Tony.
Well, Tony, welcome to Equity Mates.
Thank you, Alec and Bryce. Great to be with you. I was just listening to one of your amazing podcasts just to prep myself, and I was trying to decide who has the accent now. Can you hear my New York accent? I know what sounds to me like an accent hearing from you.
Yeah,
Yes,
well,
yeah.
I mean,
There's the one chance
definitely-
I get where I can hide my accent.
we can certainly hear your accent, but I imagine from anyone outside of Australia, we have the strongest accent. So
Yes.
hopefully you can understand us today.
So-
I sure can.
So, Tony, when you wake up and scan the markets, what's the one thing that you're always looking at first, and why is that?
Oh, Bryce, that brings me back. I began working on Wall Street in the 1980s, and there was a movie in 1987, Wall Street.
Yes.
And I was working downtown New York at the time. In fact, at that time in World Trade Center, the 104th floor. I remember the movie Wall Street, and Bud Fox, the main character, he would wake up and turn his computer on, very old, antiquated one, of course, and look at where the S&P futures were. And that's what I do. And I now, because of our smartphones, et cetera, and the access is nonstop, I look at where the stock market is. I mean, the U.S. S&P futures, meaning the top 500 companies in the U.S. in one index. It tells you everything you need to know in terms of whether there was some strain overnight, some news. I could look at the bond market, I eventually do, but the S&P 500, how the stock market's faring really tells you a bit more. And another thing to note, when thinking about bonds, we have to remember there's some equity risk in a bond, in a corporate bond. It has an equity characteristic, meaning you could lose your money just as you can in equity. Not in, now, most corporate bonds, investment grade bonds, it's extremely rare, 99 point something percent chance of getting your money back. But so that's the first thing I do is look at the S&P 500 futures, which tells us how the opening will be in the US and whether there was some news overnight. And final word is in terms of the overnight, the last thing I do at night is look at where the S&P 500 futures are and where global markets are trading, including Australia and Japan, etc. So
Mm.
it's really only about a 6 hour time span between those two
Yeah.
Checking the
points.
futures.
Well, Tony, I think you're not alone at going to sleep, checking the markets last thing, and then waking up, checking the markets first thing you wake up. Of late, I feel like everyone's been watching the markets over the past month, just trying to understand where the world is going and how things will change and be affected. But as you said, you've been in the markets for since the 1980s. You've seen a lot of dislocations and shocks and the like. So where does this moment sit in relation to your experience throughout your history in markets?
I think the key is to characterize the type of movement that we're getting in markets. There's event risk or events. There are events that cause big moves in markets, and then there's some lingering issue in a system called the banking system, for example, the real estate markets that could take longer to shake off. And it seems like we're probably in the former, which is more in the idea of an event risk, but we don't know because for all we know, this will be something longer lasting and more systemic in a sense. So I think the context should be the type. And let me give a few examples. First of all, I tend personally to try to shake off events or even geopolitical tensions, worries. Even recently, since 2018, there was worry about tariffs. 2018 is when President Trump implemented tariffs, but the stock market from that point till now is up a lot. The U.S. S&P 500 has increased over 200%, and the Nasdaq, the index that is comprised particularly of large technology companies, is almost tripled in value. So, what good did it worry in 2018 about the tariffs and the geopolitical tensions that certainly grew at that time? I could point to other periods in history. I'll go way back, and certainly before my time. The President Kennedy assassinated November 1963. Big drop in the stock market. 2 months later, an all-time high. 2001, in the building I once worked in the 1980s, of course, the 9/11 attacks, the markets also recovered from that rather quickly. 2008 was different, a different sort of thing, because there were scars in the banking system and the financial system that would take time to heal. So again, what I'm trying to get at is what we're experiencing something that's more of an event or something where there could be scars that takes time to heal and repair, such as the banking problem, real estate problem. Those things take a bit of time. So I think the final word is it's probably more of an event. We'll talk about why perhaps, but it's not likely to be something that causes great scarring, and I'll give you reasons later.
Mm. Well, Tony, you've called the recent tariff moves an audacious experiment of historic proportion. So, where do you think this so-called experiment is heading, or this, I guess, policy from Trump, and what's the biggest risk that you see playing out?
I'll start with the risks that and the near-term story, which is likely that there'll be a sudden stop in certain parts of the global economy, certainly the U.S. economy. We know from shipping information, first of all, it takes about 30 days for a ship having loads of containers on them to go from China to the port of Los Angeles and the port of Long Beach, California, about 30 days. And so, from what we know in terms of what's on the way, it looks like there'll be a significant drop off, a cliff, a sudden stop in about 2 weeks. And so, there are lots of stories now developing covering this idea that trucking companies, truckers, those who drive the trucks, may be out of a job because there won't be as many of those containers that they certainly drive around the US in. About 20% of all trucking business depends upon imports. So that business is going to be significantly affected. Another area that will be significantly affected is the retail stores. Many of them will be unable to receive product and therefore make sales. And therefore, they may decide to lay off workers because their sales will be weaker. We know that in the second quarter and third quarter of each year, for example, toy companies tend to ship a lot of products from China into the US to stock up, believe it or not, for Christmas. It's in the second quarter and third quarter that they stock up, and they're finished doing that job by September. And many toy companies are holding off on their orders because they want to see what happens. They don't want to pay a price that's more than double what they previously paid. So that's some empty shelves. So what you're going to see very soon is stories about shelves emptying out, partly because consumers will be grabbing them. Secondly, because there simply won't be deliveries. So the near-term story is not very good, and it does, and there's all the uncertainty element, of course, affecting consumers and businesses that will have a negative effect as well. So that's the near-term story. But the long-term story, as I said earlier, is just it will relate to whether or not this is a scarring issue or whether or not it's seen as an event.
Mm.
What I think will happen in the long run is that the two forces will take hold, the capitalist forces and the democratic forces. The latter, many Americans right now are skeptical, as it seems one man is in charge, certainly on the tariffs, because the president has a great deal of power in that area. But in a year and a half, and it seems like a long way away right now, the US will have what's called a midterm election. It's the middle of the president's term, where all of the Congress, the House of Representatives, will be up for re-election. Typically, at a midterm election, the sitting president's party loses seats, and there's a slim majority now, and so the likelihood is that the power will change hands from Republicans, the president's party, to Democrats. And that change in power, that shift in power, will start to affect how legislation goes and so many other things. And so there's a dynamic will change. So on the political front, we could expect that there'll be meaningful change going forward, I think. And then secondly, in terms of the capitalist idea that I was just talking about, uh, remember, we wake up every day wanting to make money, to put it plainly. The capitalists find ways to adapt and they will figure it out, so to speak. And so I think that's what will ultimately drive the economies to do better. And so the final word on this is I wouldn't be shocked to see the US stock market by the end of next year reaching all-time highs or sometime next summer. It just depends on the severity of what's up front and again whether there's scarring or whether or not this is seen as an event.
That's good to hear.
Yeah, love hearing that it might hit all-time highs.
We
but
all do.
but Tony, look, your job in this environment is incredibly tough. Trying to see where the market's going and position portfolios accordingly. But it isn't the hardest job. I think the hardest job at the moment is to be Jerome Powell, the chair of the Fed, trying to manage this moment, trying to keep America's economy going, but also manage inflation risk from these tariffs. It is the dual mandate is tough in an environment like this. So how are you anticipating the Fed responds to this moment?
Well, I've met several Fed chairs. I've worked in Newport Beach, California, PIMCO's headquarters for 8 years, and in my beginning years, and I began at PIMCO in 2009. Uh, Alan Greenspan, a legendary Fed chair, was an advisor to PIMCO. And so I met him, and I've met Janet Yellen, who's now an advisor to PIMCO, and also Ben Bernanke, another former Fed chair. So what I'm trying to get at is I know a little bit about the culture of the organization and what they tend to emphasize, and what they tend to emphasize is the dedication to the mission at the Fed, which is to carry out its dual mandate objective, which is to achieve price stability in the context of full employment. These Fed chairs that I mentioned, interestingly, in conversations that we've had with them, they tend to mention how many PhDs there are at the Fed. A bit nerdy group, sort of like NASA, the space organization in the United States. They used to say that there were 200 PhDs there. Now, apparently, there's 300. Someone once said to us, Richard Thaler, a Nobel laureate, that the Federal Reserve is the best collection of civil servants in Washington outside of the military. That's a very strong statement. So I do believe that I'm going to have more to say on this, but I do believe the Fed is very dedicated to its mission and will not be swayed. Now, Jerome Powell will be guided by the three lessons of history that he mentioned August 2022 in a speech in Jackson Hole, Wyoming, at an event for the St. Louis Fed. He said there's three lessons of history that would guide Fed policy in battling the inflation demon. One is to take responsibility for the inflation problem, something the Fed didn't do in the 1970s and caused lots of inflation. The Fed in the 1970s blamed it on OPEC because it had an embargo that pushed the oil price high and it caused a lot of inflation. Today, there could be lots of excuses, but Powell isn't having any of it. So he's going to take responsibility for the problem. Secondly, he said, pay attention to how people feel. How do they feel about inflation expectations? If they feel the inflation rate might go higher, pay attention to that, and therefore keep policy tighter than perhaps it would normally like to keep policy. Certainly, the Fed would like lower interest rates, but it would rather pay attention to these high inflation expectations and tend to them to keep the public calm about the inflation story. The worst thing that Jerome Powell could do is give in to political pressure and push the inflation rate higher by basically spurred by lower interest rates. The final lesson of history Powell said he'd heed is to keep at it. Now, that's an important comment that he gave us because it's directly from a book called Keeping at It by Paul Volcker, who's the most legendary Fed chair of all time, who slayed the inflation dragon from the late 1970s when it was double digits, conquered it, and we've had 40 years of success. So I would expect that he'll keep heeding these lessons of history. And final word is, even if there's pressure on Powell, first, it wouldn't be anything new. George Bush in the 1991 campaign for the 1992 election, I should say, during debates, and I have this in my books, a bunch of quotes from him at debates, he would constantly get on the Fed's case, Alan Greenspan's case, and say the Fed was moving too slowly. Alan Greenspan was known for gradualism, kept pressuring Greenspan, but Greenspan cut the policy rate over 20 times, just a quarter point. Bush would have rather have gone faster, didn't. Just kept at what he thought was doing what was right. Final word is just another example in history to point to. There was a political appointee, and this is a very good parallel. In 1979, and there's worries about political appointee now. 1979, G. William Miller was ascended to the Fed. He was named chair in March 1979. It only lasted a year and a half. Here's a strange anecdote. He was a non-smoker, so he banned smoking, and it was allowed. I even remember it back then in the 80s. They allowed smoking in the Fed building where the Board of Governors would meet, but he removed them. Miller removed the ashtrays, I should say, from the room and said, no smoking here. But two governors, and there's 7 governors, said, we're not having any of that. So they came back in with their ashtrays, slammed them on the table, and smoked right in front of the chair. Beyond that, and more importantly, the board would consistently outvote the chair and did what was right. So I think that there are lessons in history. There are periods in history where we could see that the Fed chair does, in fact, matter, but the institution has great integrity, and you could expect that it will proceed to do what is right.
Well, Tony, we've seen falling stocks, we've seen rising yields, falling USD, capital flying out of the US. is the US still investable? Is it the safe haven?
Is it still investable?
Is it the safe haven that we once thought it? Whoa, that we've come to rely on so much, or is all of this overblown?
Yeah.
Well, Bryce, you might be onto something. That's
Oh,
the
okay.
feeling, and that's why the U.S. dollar on a trade weighted basis, it's fallen almost 10%. So it does seem there's some concern about that, and there's evidence, some data that seems to suggest international investors have been selling U.S. equities, thinking U.S. exceptionalism is over. The government does seem to be in the way, but what the global investor should be confident in is that the U.S. system still works, the Constitution's still intact. There will be ultimately a change in government. If people don't like who's in office, they'll vote that person out. Currently, the policies of the executive branch are not very popular, and so we could expect ultimately, as I said, in the midterm election, some shift in power that creates a little bit more balance. What the stock market tends to like, what the global investor tends to like, is divided government, meaning a difference between some where the Democrats have some power in either the House of Representatives or the Senate or in the executive branch. And so again, the final word is uh, investors should be confident that the U.S. system is intact, meaning the democratic system. The checks and balances will work, and that'll allow government to get out of the way, because many businesses will say that government's in the way now with these tariffs. So it probably will not be long lasting, and investors should be very confident in the innovative nature of American companies.
Mm, mm.
So Tony, to follow on from Bryce's question, I think when investors were selling the US over the past month, getting out of the dollar, and selling bonds, seeing yields rise, and stocks were falling as well. And then I think the second part of that conversation that often happens is people say, oh well, the US dollar might lose its status as the reserve currency. There might be a new global monetary order. Then people point to the BRICS nations, and they start talking about China settling oil trades in non-US dollar. That story seems to pop up every few years. How
Mhm.
do you think about the potential for a new global monetary order? Is this just the latest version of a story that pops up its head every few years, or is something actually changing in this moment?
Oh, you're right, Alec. This is a story I've had to talk about for many, many years. It seems a constant question in client meetings that I've had around the world, literally for decades now. This is constant worry. It's a little bit more legitimate now. Now, first, the backdrop is that there've been only two regimes, two monetary orders since World War II. First was called Bretton Woods, which was a managed system. The world decided it wanted the currencies to be managed. They wanted stability. That lasted till the early 1970s, when it became a free floating free for all. And we've been in the midst of that since. 2015, to your point, Alec, I wrote an article about this idea of a new global monetary order. So 9 years ago, after China had devalued its currency by small amounts, just a few percent, in August 2015, then January 2016. In both cases, the global stock markets fell 10% each time, demonstrating that if there's a change in the order, it can have a meaningful impact on markets. Why? Because, for example, if China were to devalue its currency on its own, it can affect the region, it can affect Australia, etc. Because the weaker China's currency is, the more that the world will buy goods from it rather than neighboring nations, and therefore disrupting those nations. And so there is that possibility. Now, that's the backdrop. So we might be in the midst of a new order where this managed system gets reintroduced into the floating system, because the world is saying we're a little bit leery of the dollar. Let's invest our currencies elsewhere. Let's exchange it into other currencies now. And so that might mean some change. Now, the US dollar represents 57% of world reserve assets. What are reserve assets? Those are the monies held by central banks that they built up over time from trade surpluses. And so that most of that's in China, about 3 trillion of it. but 57% of those assets. Now the euro is 20%. The Japanese yen, the British pound, the Canadian dollar, a few percent. The Chinese currency, smaller in holdings, less than 1% than Canada, which is a much smaller nation. Now, if you were to line up friends and foes of the United States and they went to their respective corners, and you added up how many reserves do these nations have, the friends and the foes of the United States, you'd find that the percentage that would likely be held in dollars, because in a friends foes scenario, and where they move to the respective corners, uh, you'd see the number still around 60%. What I'm getting at is there is potential for change, but in terms of where the money goes, it probably won't go into the foes of the United States. It would go into the friends corner, and that might include the euro. So what I could see happening then, final words, is some move to a plurality, meaning rather than be 57% of global reserve assets, it moves to 49%. What amount of change is that? Just 8 points, right? So 8% times the 12 trillion, that's $1 trillion of movement in assets over time, which can easily be envisioned. China holds 780 billion of treasuries. You could see some further chunk of that coming off. By the way, they had 1.1 trillion in 2022, so they've already sold down a few hundred billion. So that number of 57% probably going to keep falling. There'll be more small trading blocks, mini trading blocks that causes some of that money to flow away from dollars.
Well, Tony, we want to move to how we should be investing in the current time. You've said PIMCO have been positioned defensively now for some time. So what does that actually look like in practice? Like, what is the framework that you're thinking about?
Well, defensiveness might sound perhaps as if money's moved out of bonds and stocks and into cash, but that's not the case when we think about it. It might mean moving from one asset to something that's more liquid, but may be higher yielding and may be better performing in times of stress. And a great example of that we've touted for some time is mortgage-backed securities. These have yields in the U.S., for example, 1.5 points more than U.S. Treasuries, and that's a wide spread. Typically, it's 70 or 80 basis points. It's almost double. Importantly, that spread of 150 to 160 of late is more than the spread, the yield pickup, if you want to call it that, than you could get in corporate bonds. Now, the main feature there, well, first of all, the yield is better, so that's good, right? There are other reasons why investors sometimes choose corporates, but liquidity is a top reason. So we like the yield. Liquidity, though, is a big thing. In mortgage-backed securities, the daily volume in the United States is $300 billion. Now that's a lot. The U.S. Treasuries trade about 750 billion worth. Corporate bonds, individual corporate bonds, and there are many, many companies in the world, they can trade by appointment. And so in a time of stress, those trade by appointment bonds don't do so well, even though the companies themselves may continue to flourish and pay you back at maturity and pay you your interest. Now, since 2008, there's been a change in the way the plumbing works in the financial system. Regulators said, hey, intermediaries, we don't want you holding too many corporate bonds and other securities anymore. We want you to become movers, not warehouses. So don't hold any corporate bonds. So back in 2007, before the crisis, these intermediaries held 300 billion of corporate bonds. Today they hold about 5 billion, even though the market's doubled in size to $10 trillion. The important thing there is that it's a game of hot potato when investors go to sell those corporate bonds. I don't want them, you take them, and the prices go down faster than they would in mortgage securities, and that's what has tended to happen. So you could expect that when there's times of stress, that these bonds they often move through the same pipe, and so we'd rather be in the more liquid instruments so we can pivot and pounce, if you will, if assets do go out of whack. Now, one final example to seal the point: 2020, COVID, these corporate bonds, triple B rated. Now, triple B rated bonds is the lowest level of investment grade bonds. It goes triple A, double A, single A, then triple B. The default per year, according to Moody's, historically is 0.1%, meaning an investor in triple B rated bonds has a 99.9% chance of getting his or her money back. Yet in 2020, the stress by this new system, post GFC system, caused those bonds to trade at low price, such low prices that it suggested it implied a default rate of 10% to 15%, even though those companies had very good long-term prospects. So liquidity is one way in practice that we manage this defensiveness. It's a key feature of it all. And final word is look for bend but not break types of investments where we think even in a time of stress, the cash will continue to flow through to those companies and back to the bond investor.
Tony, there's so much going on in the bond market. Whenever we speak to people that are focused on fixed income, the complexity of it all gets my head. You're dealing with liquidity, you're dealing with duration, you're dealing with credit quality and different issuers. Then you're actually looking at yields and what your expected return will be. It's there's so much going on. So for people like me who are just trying to get my head around this market, who might hold a couple of ETFs, might hold a couple of PIMCO active ETFs that are now listed here in Australia. And they're just thinking about how they can sort of build their portfolio for the long term, protect their downside, and try and capture some of the upside. How should we be thinking about fixed income ETFs in our portfolio, and what role should they be playing?
Well, you're right to be confused, Alec. That's why I wrote 6 books on the bond market. One of my books is 1,200 pages about the money market.
Oh, God.
Jeez.
I doubt
Jeez.
that there's too many books in the stock market that need 1,200
No.
pages. So it is quite intricate, but that's what kind of makes it interesting. ETFs are really a great way to play this very complex market because it is complex, as we discussed. But ETFs are quite efficient. There's a lot of transparency, and there are lots of them. And with a good advisor, certainly, or a well-educated investor, can easily find a set of ETFs to diversify their portfolio using bonds. Now, diversification is important, of course, and we do think that the correlation between stocks and bonds has returned to the traditional way, which is to say that we would expect bond prices to go up when stock prices go down. So that's the beginning part of this idea. So PIMCO has an active ETF that we really like, and a lot of investors seem to like. The diversified fixed interest active ETF. It's a blend, generally speaking, of almost 50-50 between global bonds, and we like lots of global bonds, including the UK and Australian bonds ourselves, other parts of the world, and Australian bonds, including semis, for example, which have a reasonable spread pickup in yield, could be 50, 70 basis points over Australian government debt. And so why not invest in those given that the credit quality is so high? So lots to do there. And the yield on it today is about 560 or so. That's a pretty good yield. And that there's something important to say about that, which is that the starting yield is the major determinant of future returns. It's an easy way to grasp bonds. Simple concept. With 94% correlation, the starting yield today, when looking back 5 years from now, 5 years back to today, you'll find that the starting yield was what determined the 5 year rolling return. A 5 year rolling return is another way of saying what was the yield that the investor received on an annual basis over a 5 year period. And again, voila, it's pretty simple. It's the starting yield. And so that kind of type of yield gets us excited. Most ETFs in the fixed income realm are between 5 and 7% these days, and it's unlike what we saw last decade when it was awfully low. So it's pretty good time to be investing. So we like the diversification approach. We like the global approach. Final word on this is that PIMCO has a global footprint. I've been to many offices of PIMCO, nearly all of them, including in Australia 6 times, and I hope to be back soon. It's important when there's a global footprint. If I'm in Japan, for example, I know that my Tokyo-based clients can speak to the Bank of Japan or the Ministry of Finance, not only because they could speak Japanese and I can't, but simply because they have the knowledge of the culture, etc. It's really important, and So having taking a diversified global approach in a giant bond market, $130 trillion in size, is the way to go, to our thinking. Final word is the rating on this, the average credit rating for this fund, which has a symbol of PDFI, is double A. Now, double A in the bond market means a 0.02% chance of default, 99.8% chance of getting your money back. So to achieve those sorts of yields in such high quality bonds is an important thing to us.
Yeah, it is pretty exciting that fixed income's back. I mean, Bryce and I started Equity Mates in 2017, and I think for most of the life of our, I guess, investing journey, it's, there's been articles saying the 60-40 portfolio is dead, and, yields on fixed income have been so low that a lot of investors have kind of moved out of this space. Have you seen a real excitement? Like, have you seen a lot of investors come flooding back as yields sort of have a 5 in front of it, and people see there's decent income to be made here?
Yeah, I see weekly flow information as part of the investment committee at PIMCO, and it's been pretty good. I think we've crossed the $2 trillion mark in terms of assets. And I know from visiting clients, United States and throughout the world, and hearing about what has happened in terms of flows from those clients, that the numbers have been very good. And so we would expect that to continue because the levels are high. So what people often ask me, what keeps you up at night? And there are many negative things, of course, but the thing I would worry about as an investor is missing these yields, because as I said, since the starting yield is what will determine the future return. Imagine if there is a recession, and I mentioned the idea of a sudden stop in US data. What if that causes a big drop in yield? I'd hate to see a client miss that, an investor miss that, an advisor miss it. And so it is an exciting time, and we have had strong flows for more than a year, and would expect it to continue so long as yields are in this realm. But sometimes those flows occur simply because people are nervous about the world and they flock to bonds. That's what happened in the early 2010s.
Well, just for those listening who might not have caught it, you referenced there, Tony, the PIMCO Diversified Fixed Interest Active ETF. The ticker is PDFI, giving a diversified exposure to global and Australian fixed interest securities. So, Tony, to close out today, there's a lot of doom in the headlines, but your closing notes that you write often always seem to hint at optimism, be it through invention, adaptation, resilient, or the like. So what gives you hope amid all of this sort of macro fog that we're going through at the moment?
Well, Bryce, something I've often thought about, and we talked earlier about how today compares to other points in history, and you could point to many periods where markets seem to be resilient eventually, and eventually reach new highs. I'm considered the resident optimist at PIMCO. There's not too many.
Nice.
Bond investors tend to be quite bearish and leery, always looking over their shoulders because they have to. They simply want to get their money back at maturity. So kind of gloomy in that sense. But I tend to take a more optimistic approach, and I relate it back to a book I read a long time ago, and anyone can read, from Adam Smith, who wrote this book, The Wealth of Nations, in the 1700s. The idea being that we all wake up every day, and you and I are now talking, trying to help investors make good decisions about investing. We all want to fare better for ourselves, for our families, and maybe for our egos, what have you. And that drive to fare better every day is what keeps it all going. The capital markets going, and it never ceases. And so we've got plenty of evidence of that, and we just know from our personal experience that we want to fare better. And it's ceaseless, and we have a remarkable ability to adapt to stress. So many examples of that through history. So I will never be a pessimist.
Nice. Well, we thank you so much for coming on today, Tony, all the way from New York. There's a lot going on in the macro environment at the moment, so the more we can understand, the more it helps us with our own investing journeys. And we do really appreciate you coming and sharing your time with the Equity Mates community today. So thank you very much.
Thank you, Bryce and Alec, and great thing you're doing in educating people because it's an area that's underserved throughout the world. And so kudos to you on your 8 years.
Well, we appreciate that.
Thanks, Tony. We appreciate it. Next time you're in Australia, we'll do this in person.
I hope soon.
Yeah.
Thanks again.
Thanks, Tony.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.